Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, June 9th, 2020. I'll go through this one relatively brief. We won't keep it too long. It's largely an update of the mid-session video that I did earlier today. What stands out, we didn't have a lot change since then. We had today we had QQQ close up 0.72%. Which again, QQQ, although it's not a very diversified index, a lot of traders do follow it and track it, and it's indicative of what's going on today. We had a handful of stocks doing almost all the heavy lifting in the market. We ended up closing, as we had earlier in the day when I did the video, 11 of the sectors in the S&P 500, of the 11 I should say, 10 closed negative. We're down all day and closed red. There we go. So only tech sector, and that's again reflective of Apple and Facebook and those big market leading FANG stocks doing all the heavy lifting. And some pretty heavy selling in industrials, down 2.5%, financials down 2.13%, utilities aren't going to move the needle, but energy really got hit hard, 3.76% today, and even healthcare down 1% right there. So just wanted to mention, not a lot changed since then. So 0.72% up, whereas QQQE, the equal weighted NASDAQ 100, if I can load that, closed down 0.75%. And you don't see that very often. And again, it's just, like I said, is it a complete market's going to crater tomorrow? No, and maybe it's a one-day thing. We shrug it off tomorrow if we have some better market breadth. But just something to monitor. And there's QQQE, the equal weighted, right at that trend line right there. Look at the other indexes. The S&P 500 closed down 0.75% as well. You had the Dow closed down 1%, a little over 1% right there. And a lot of these, you have these trend lines here. I'll flip to a different board. You can see it there. DIA, even the mid and small caps came under some pretty heavy selling pressure today. 2% down on MDY. That's a mid cap ETF, right there, right about at trend line support. So again, something to watch for, especially because a lot of these indexes have these recent island clusters with several candles right here separated by a gap. That was a gap on Friday's gap right there. We gapped up on Friday with the jobs report. And then last but not least, IWM, same story. You have a little island of 3 candles right there. It's not an island yet, or at least not finalized. I mean, it's an island now, but to get an island cluster reversal, you need another gap on the other side of it. So we'll watch that. And should that happen too, here's an interesting note, is it wouldn't just be random. It would also mean, again, if it happened tomorrow or the day after, it would mean a break of this trend line as well, and that could be a pretty powerful sell signal. And then you have that big 145 support. Remember, that was a level right here in this purple line, rolling back in time here. This is a daily chart of IWM, the small cap index, and we just had numerous reactions along that level for the past couple of years here. So it was a big level. We had a lot of momentum carrying upwards, and the bullish until unless that level is taken back out. And so one possibility here, I mean, the market has had a very strong aggressive bid, until, of course, until today. But what this may also be, I talk about momentum fueled overshoots. When you have a key support level during, let's say, a powerful downtrend, whether it's a stock or an index like this, it's not common. It's not uncommon. In fact, it's more than common to briefly overshoot that level and then snap back. In this case, maybe that's what happened here. We had a lot of momentum in the small caps leading up to that move to 145. So again, only time will tell. If you're bullish looking for new highs in the small caps and we have a pullback to 145, I can tell you that was and still should be a very significant level. In fact, we didn't just take it out randomly. We gapped right on through there. You can see this was a 145 level right here, and that was the Friday's jobs report, gapped us way above it. So that was impulsive breakout above it. So TA 101 says, that resistance, once taken out, then becomes support. So, those bullish looking for new highs, if you're looking to buy dips and a pullback, that's where you'd want to enter. Those looking to maybe short an overextended rally, disconnect with the fundamentals in the economy right now, might want to wait for a break at that level as well, or other sell signals such as maybe a gap down to leave an island cluster top up here with those 3 candles. And then the other things I covered mid-session, treasuries have been pretty strong last few days since that reversal midday on Friday when we hit that trend line I covered in ZB on Friday's video. Some more follow through there. And what I've also noticed today, some interesting developments or things to watch for in the junk bond market. So just lately, credit spreads are rising. What a credit spread is, it's a differential between what treasury bonds are paying and what junk bonds, or those are any bonds that are below investment grade rated. So anything triple B and above up to triple A is investment grade. Anything below triple B, such as a double B or lower bond, is a junk bond. That's the nickname they call them. They're still paying, until they're down to down a D. It means default when they get downgraded to D. So you can have a C-rated, triple C-rated bonds, things like that, and they're still in the realm of the junk bond arena. Now, this is where the Fed came in heavy to support the market, to shore up the credit markets in large part. And what I've noted here today is that we pulled back and we're testing that trend line. So it's not mere coincidence. I talk about this often. Treasury bonds don't trade, tend to trade inversely, meaning opposite to what stocks do. Usually stocks are rallying, treasury bonds are going down, and vice versa. However, junk bonds trade much more in line with the equity markets because they are more impacted by economic conditions or expectations of future economic conditions than they are by interest rates. Most investment grade bonds like treasuries and higher quality corporate bonds, the biggest determinant of their price is what interest rates are doing. When rates go up, bonds go down in price and vice versa. But these guys tend to move with the stock market. So it's not mere coincidence that you also have a comparable trend line right here, and there's JNK right at that trend line. Also worth noting is we had a big old gap right here. I mentioned there was an important gap on SPY recently that SPY was testing, and so far failed to surmount. And we also have a big old gap right here that really kind of kicked the party off on junk bonds. It broke down, back tested it, never looked back right there. And so we failed so far 2 days at that. It's about 105. So we're pinched between support and resistance on junk bonds. And if we can pop that level with conviction and continue higher, that's bullish. However, if we fail here and we go on to break down, that would be bearish. Another one to watch in addition to JNK. JNK and LQD are the two main, they've been around for a while, junk bond ETFs. And then this is one that came about in recent years, FALN. It's iShares Fallen Angel. So these are companies that have only recently been downgraded to a junk status. They were investment grade. And this is really the market the Fed has come in heavily to support as well. So I think it's worth it, it bears watching. And just like it's similar counterparts, JNK and LQD, you have this uptrend line right here, and we closed at it today. You also rallied into resistance, and Fed support or not, from a fundamental perspective, sure, things are getting better on track, but we're far from 100%. And by just about any economist you talk to, or anything you read, it's going to take a while for the job market to get back to where it was in February. And remember, at the end of the day, consumer spending is 2/3 of GDP. So it's just insane to think that junk bonds and a lot of stocks, not some of them, some stocks have profited and benefited from what's gone on the last few months. But again, these are way too high, and a lot of that it's a combination. I'll be honest with you, and I don't know if the Fed discloses how much they're buying. I think it was they really started rallying just when the Fed came in. It was right here and said they would support the investment grade in the investment bond market. The corporate bond market, as well as the junk bonds, and especially those that recently were knocked down to junk status. So again, I think that was a lot of buying driven up on expectations that the Fed would save the day. And my guess is, if were lucky enough to be sitting in a room with them, all the Fed officials, I think they would say, you know what, probably a little bit too much. This market's probably gotten ahead of itself here. They didn't want to see, and I said it before when we were falling here, that the corporate bond market, the whole system would break if corporate bonds continued to fall much below where they were. So the Fed had to come in and do something. But again, wow, to see them back or near their all-time highs to me is just insane. So I'll quit talking about the fundamentals and where I think they ought to be. But again, the technicals are pretty clear to me. There's a trend line to watch, break of that, and that should bring things down. Well, it's not a trade idea. I'm just monitoring it because it will have an impact on the stock market. If you continue to see just this, it's only a couple day trend here, but if you continue to see investment grade or below investment grade bonds fall and treasuries rally, then that is again, that's sometimes often a red flag for the stock market when you see those credit spreads widen. In other words, the difference between what the investment grade bonds and the low grade bonds are paying. Okay, and the other things I continue to watch is the US dollar, the euro, gold, silver. I mentioned this morning we had a breakout in the dollar, but it was suspect. It was called into question because at the same time we didn't have, right before that, we had a breakout in the euro which actually failed, or breakdown. So the euro broke down below trend, snapped right back up, and it's above it, and therefore that caused this whipsaw in the dollar because the euro is by far the largest component in the dollar index. A distant second as far as weightings go is the Japanese yen. So when the euro did that, that's what caused this on the dollar. However, the technical posture of the dollar hasn't changed. We still have a divergence building. As I said it would today, if we went on to make another low, it would only extend the divergence. So at this point in time, we had one whipsaw through the trend line here. Next one could stick, but I think a break above 97.060, which should do the trick and spark a rally, and I'm still targeting all the way up here at about 98.77. Ultimately work our way up there, but again, it works like this. You have to, you break one resistance level, you rally up to the next, get a reaction there, break that level, whether you have a reaction or not, and then the next one, and so forth and so on. So it wouldn't be a straight line up. There'd be some zigs and zags along the way. But again, we had a buy signal there, but it was called into question with what was going on in the euro. So that's why I do these videos. That's why I sit here and talk for 20, 30 minutes and don't just say, hey, the dollar looks bullish, because there are all these little nuances, all these other things you have to keep in mind that can trigger these whipsaw signals and everything else. So when you're in a pretty strong trend, like the stock market's been in a solid uptrend, very resilient lately, the stock market has. The dollar's been in a pretty consistent and persistent downtrend. You give it the benefit of the doubt. And the benefit of the doubt says you want to check all the boxes you can. And again, euro didn't really check that box today. Gold, like I said, we broke down on gold. And at the time of the breakdown, one thing to note, we had this recent trading range, was we had a bullish divergence put in there on the 60-minute, and that did end up being the catalyst for this rally. It's brought us back within the range. So gold continues to just trade sloppy. It's in a longer term bull market, but the trend for our last couple months here has been sideways in that range. We're back in that range, just as we had a little whipsaw back here and a little one down there. So it's not a super well defined bottom of the range, and you might want to even use that reaction low from right here and say, well, maybe that's the bottom of the range. You could do that as well. Silver, silver is still, the divergences have been putting pressure on silver lately. We had that divergent high here. We broke the trend line, impulsive selling, hit the first two targets. Then the third, we took out the trend line. That came in at that second target, 17,736. And back test. That's what we've been doing here. So, from a pure technical perspective, if everything, all other things being equal, I would say I'd have a higher degree of confidence. I would say that this is an objective time to add to a short position or initiate a short if you don't have one. However, I want to see, since that trend in the dollar has been resilient, I think that would help the case. If we can see a breakout in the dollar and a pretty strong rally in the dollar, that should put pressure on gold and silver and bring silver down to some or all of these next targets. And if not, it goes the other way. If the dollar continues to drift lower, maybe silver will continue to backtest this trend line, maybe even pop back above it. As you can tell from my voice, my convictions aren't strong. I've been saying this, and that's part of trading. A lot of times I like to watch and see, wait for the higher probability setups. But I think these things are worth monitoring. And then other than that, just, like I've covered in videos recently, Individual stocks are where it's at right now. The stock market is a combination of thousands of stocks, some very bullish, some very bearish. We've had numerous trade ideas in the last week or so that were highlighted up well into the double digits, 20, 30, even this one, from the breakout to the highs today, 50%. The majority of those long trades that have triggered an entry profitable. Some of the short trades profitable, most kind of just holding their own, which says a lot too. And when I look at some of the things that were down today, I see some big profit taken. This is where I talk about this, a rally like this, an overextended, very overbought rally, like a game of musical chairs. Let's say you were trading Chesapeake, had a very bullish chart, like a lot of energy stocks, big move, breakout, everything you want to see, impulsive, second follow through day, up 350% since the breakout, but most of that was wiped out today. So if you were, and you couldn't do anything about that. Let's say you were in Chesapeake, and you might say, why would I sell? This is a breakout. This stock's going up, 100% or more a day, and then boom, you lost almost all your profits today. Not that I mentioned this one, I'm just pointing out some. And this is what happens when the music stops and you don't have a chair. This is what happens when momentum traders are in there, and you get these huge gains. And what I'm talking about, being unable to protect your profits, stops are useless against gaps. There are two types of stop loss orders when you're long. You have a stop loss order, which is and you want to have them good to cancel. You can have a stop loss order or a stop limit, and I can't spell that out. I don't have a drawing tool here. A stop loss order says, let's just say that day you put a stop right here, said, stop loss if it goes under whatever it was, $69, whatever the number is. Well, we opened today. We closed yesterday at or Chesapeake closed at $69.92, so we'll call that $70. Today it opened at $19. Guess where a stop loss order would have filled? At the open. Stop loss orders are, once a stop price is triggered, are immediately converted to a market order. And what happens, you have order imbalances at the open. Everybody's market orders, stop loss orders get hit at once, and that's where you would have been sold out at. Now you say, okay, well, I'll use a stop limit order because that says sell me at 70, or let's say in this case $69, and only 69, no worse. You can only fill me better. That's what a stop limit order says. So if the stock drops below $69, the stop limit order is triggered, but it can only be filled at, in this case, 69 or better. So guess what happens? You're still long this stock. Your order never triggered. Your stop price was triggered, but they cannot fill you because it never traded at 69. And if it continues lower, well, guess what happens? You're still in the position. So. And again, there's some other ones out there, big names that you've heard of, Fossil. These stocks are, this is what I'm watching today. I'm seeing a lot of very sudden and swift profit taking. And this is something I'll be watching for. It could be one day wonder. Maybe these stocks will bounce hard tomorrow and go back up. But again, a lot of them, many of them, but not all of those were in the energy sector as well. So, healthy profit taking, but I'll tell you, some of them dropped quite a bit today, and that's just not good technical sign, like those like Chesapeake and CRC and all that. That's pretty ugly price action. It traps a lot of longs in there, and not a good thing. All right, so we'll wrap it up here, and we'll pick this up tomorrow. I'm going to run out a little bit. I have to do a couple things in the morning. If I see anything big, I'll put a pre-market update out there before I leave. I'm going to be gone just before and or after the open tomorrow, and then back at my desk. Should be back by 11 a.m. tomorrow. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.